Good morning everyone and welcome to the Moneycontrol live stream. You're watching another edition of Markets with Santo and CJ. Well, today of course we're going to talk about a debutant basically who's going to make its debut on the market, and this is of course Kaynes Technology. Do not confuse it with the economist John Maynard Keynes, of course. That is Keynes. This is Kaynes. But of course,
good attempt at humor by CJ.
Yeah, always attempt, Santo. I don't get humor anyway.
Or rather, if I may say, a PJ by CJ.
Absolutely, absolutely. That said, let's look at this company and put it in the spotlight today. Now, if you look at, recently the listing on Dalal Street have largely done okay. There have not been a disaster, of course, of the likes of Paytm that we saw towards the fag end of the bull market last year. But this time around, the last two listings that have happened earlier this week, they were not that great. If you look at Arch Chemical and 5-star, business finance, they did not have that great a listing. But the hope with Kaynes Technology is that it could probably have a blockbuster listing, probably one of the best listings in 2022, which has not been really that great as far as the primary market is concerned. Now, Santo, if you look at the grey market premium for the stock, it's clearly indicating almost upwards of 50% jump or a premium for the stock when it lists on the Bourses today at 10 o'clock. And overall also, if prior to the IPO, of course the IPO did see very, very strong demand from all segments of investors. But prior to the IPO also, a lot of analysts, were quite buzzing about the stock, given the fact that it seems like another pure play defense, company which is entering the market, in the sense that it provides services and technologies and engineering services to a lot of defense companies in India. Not only in India, also globally. It has about 21 overall customers globally, with the order book of in the region of about 2,200 crores, Santo. And at this point of time, the expectation from this company is that its profit may as much as triple by FY24 alone. So clearly, this is a high growth stock which was available at least at the IPO price at a reasonable valuation, and it's going to probably be quite in demand even after a very strong listing today.
Well, CJ, I've never been a great fan of IPOs for obvious reasons, because
scarred by the 90s.
Oh well, more than that, in the run up to the IPO, in the last 2 years, you will always see a big jump in revenues, profit, and it's only a handful of companies that actually manage to sustain it. Now, what could be in favor of Kaynes at this point in time is that defense is a hot story on the market at this point, and anything closely, remotely related to defense will do well, and so I think that itself should give a good bump up for Kaynes Technology when it opens for trading today. But that said, some of the estimates that it has, I've been going through some of the analyst notes, the estimates appear to be quite aggressive. Now, if you were to look at trailing earnings, and that's the only thing that is there for sure, it's quoting at about 65 times price to earnings, which is fairly stiff. I wouldn't say it's cheap, and not that the company may not be able to deliver, but it's not cheap for one. But that said, if the company manages to deliver, it is another story. Although in the first few days, initial days of listing, it's usually technicals that come into play, demand and supply purely, and from what the grey market is indicating, maybe you could see a strong listing, and the strength may sustain for a few days. Investors may also take hope from the fact that Sirma, which had listed in August this year with a similar line of business, that IPO has done well. It listed at about 220, it's at 301. So everything seems to be in favor of Kaynes Technology coming out with a strong listing this morning. But that said, CJ, I will still be cautious. Remember, the last 3 or 4 IPOs, as you yourself pointed out, have not done well. In the case of Bikaji also, although it's an unrelated industry, there's been a lot of hype, and despite that, the stock has not gone anywhere after its listing. Mid and small cap stocks in general have not been doing too well. So these factors do make me a little cautious at this point, CJ. It is good for those investors who have managed to get shares in the IPO, because once it opens with a gap up, later on you may compare with the IPO price and say, yes, the stock is doing well, but those who got in late, probably the returns may not be all that well if the valuations are not in your favor.
That is a fair point, Santo. But I think the crucial question for IPO investors would be whether to probably cash in on your profit that you might see today, probably after a very strong listing, or whether you should hold it on for the long term. My perception seems to be that probably this is one stock that you would only want to partially book profits in, provided that of course you have got a decent amount of allocation of shares. Of course, if you're holding just about 100 to 200 shares, then probably it does not make sense to book profits at this point of time, because then you can probably compound your earnings quite meaningfully in the long term, especially if the story plays out to script. At this point of time, it's not only that defense is the key theme, Santo, for this company. It's also a beneficiary of the China plus one narrative that we are seeing in the global economy at this point of time. Many of his clients are very prestigious clients with whom it has had long-term relationships which have continued for many years. So clearly there is something brewing here in this company, and that is probably one of the reasons why the market was so excited when it came to the primary market. Well, moving on, Santo, looking at the trade setup for the day today before the bell, and it looks like we are going to have finally a positive start on the Dalal Street this morning. If you look at the SGX Nifty futures, they are indicating a slightly positive start. Cues from Wall Street, however, were not that great. It was an extremely choppy session in Wall Street, which ultimately ended in the negative territory. But the market of the day, if you can call it, was, or the asset of the day was oil. Oil plunged $5 initially after a WSJ or Wall Street Journal story came out that OPEC Plus is looking at a possible increase in production, which would be contrary to what they have been doing for the past 2 years. But after that, little while later, Saudi Arabia came out with a stiff statement indicating that any such story was actually factually wrong, and they are not looking at any such measures, and that really led to a $5 rebound in oil, ultimately closing at the same level where it was on Friday. So clearly very a lot of volatility in the oil market, and will be interesting to see, because yesterday UBS Securities came out with a view that they are expecting oil to go back, Santo, above the $110 per barrel mark in 2023, whereas everybody else is at this point of time pinning hopes or betting in the market that oil will probably fall towards $75 or even $70 per barrel in the coming 12 months.
Well, that said, the mood on the street is a bit cautious this morning after losses in the last couple of trading sessions. Maybe the indices could still climb higher, but at the same time, the rally could be narrow because most of the gains are likely to be led by frontline shares, as has been the case for the last many weeks now. If you've noticed, small and mid-cap shares have been struggling for some time. And CJ, the word on the street again is that operators are not really relishing this rally, because typically the sentiment is upbeat when retail investors make money, and retail investors at this point in time don't seem to be making much of it. And there's also, again, anecdotal evidence though. People in the market have been saying that a lot of these small case portfolios, they have not been renewed, which means that retail is not making money. And when there is not enough retail participation, what happens is that operators find it very hard to move in and out of stocks. It's easy to accumulate shares in this market, but it's very
seeking exit,
when it's seeking exit, that becomes a problem, and that is the issue that we are seeing right now. And with that, let's quickly move on to some FNO cues at this point. We're seeing short covering in futures of Polycab, L&T Infotech and Siemens, and we are seeing long build up in Escorts and NMDC.
Well, thank you, Santo. Moving on to the newsmakers of the day today, and again, of course, on my list today, it seems to be Nykaa, Santo. Block deal after block deal, it's just not stopping as far as Nykaa is concerned. And another block deal is on the radar today. Lighthouse Fund, India Fund would be looking to exit the company. They're looking to, sell stake worth about 320 crores in the market at a very small discount though, which is I think if you were to flip the narrative, it's actually a good thing, because the narrowing of the discount that we are seeing in recent block deals probably indicates that the majority of the selling pressure either is over, or there is very strong demand for the stock at these current price levels. So probably once the selling pressure is over, Santo, I think you could see a little bit of a spring coil effect that we probably also saw during the time of Zomato back in July. So I will not read too negatively into this. Of course, these are funds who have made a lot of money. They have doubled, trebled. In sometimes it's a 10x gains for them. So of course they are, privy to, booking some profits. But clearly the fact that the discount is narrowing so much in the block deals that we have been seeing recently indicates to me that there is strong demand at current levels.
Well, this is a segment where actually we are not supposed to cross roads, but some of the stocks are such that I can't but help having a
always. You're most welcome to have a go.
Well, CJ, you're really clutching at straws.
Okay.
You're overlooking the fact that the trades are happening at a discount. Now you're saying that the narrowing of discount is still a good thing.
Because it is, I think, if I'm not wrong, it's about a 0.5 to 1% discount to the price that the stock closed yesterday, clearly indicating that they don't really need to offer, if you're offering about 18 million shares on the market, clearly you would expect to offer at least a 5% discount. That is generally how the trend goes. But the fact that the company or the fund is getting demand for shares at 0.5% discount for 18 million shares for a stock which is supposedly being battered, it clearly indicates that there is a strong support level now emerging for the stock in this market. Santo.
Well, my newsmaker of the day is JK Paper. It will be acquiring 85% of the shares of Horizon Packs and Security Packs Packaging. Now both these companies are into corrugated packaging, and together they had revenues of about 832 crore in the year just gone by. Now JK Paper is also setting up a corrugated packaging facility in Ludhiana. So when this acquisition finally comes through, it will make JK Paper one of the largest players in this segment.
Well, thank you for that, Santo. Moving on, the top brokerage bets of the day, and Santo, your first pick.
Pidilite by UBS. Pidilite has a rating neutral on the stock with a target price of 2,850. Now, according to Pidilite, high inflation and negative consumer sentiment have impacted demand for Pidilite's products. Also, UBS has trimmed FY23 estimates for Pidilite by about 9% on elevated raw material costs, and also UBS sees higher ad spends by the company in the second half of this year. And UBS has also flagged the fact that input costs have almost doubled in the last 2.5 years.
Clearly, Santo, it was not a very pretty quarter for Pidilite in the September quarter. Moving on, the top brokerage bet for me today would be HEG, actually, from the graphite electrode space, and ICICI Direct came out with a report post the company's earnings, and they have surprisingly actually upgraded the stock to a buy rating from a hold rating with a target price of about 1,225 rupees. Now, one of the reasons why they have upgraded the stock is the fact that they believe that there could be very strong demand for graphite electrodes going ahead in the medium term from the steel sector, specifically because a lot of these steel sectors are moving away from the current furnace technology, largely driven by the fact that they want to become carbon neutral. Of course, we all know with the COP27 going on, a lot of countries are now at this point of time focusing on reducing the carbon footprint and steel sector, which are also trying to assuage a lot of ESG investors who are investors in their stock. They are also trying to move towards reducing the carbon footprint, and one of the ways to do it is to utilize certain new technologies in the steel sector, which actually makes use or has a critical use of graphite electrode. So across the world, there is an expectation that graphite electrode will be high in demand, and HEG, being one of the largest suppliers of the product, will probably benefit a lot going ahead. Also, there is a new graphite electrode capacity of about 20,000 tons that is coming online in 2023. Overall, the company is looking to raise its capacity beyond 100,000 tons at this point of time. So the situation from ICICI Direct's point of view is quite rosy as far as the demand is concerned. But at this point of time, of course, we have seen that the stock, after rising to a record high in 2021, has not been doing that well. So will be interesting to see how the market reads this commentary coming in from ICICI Direct at this juncture. Moving on, I think let's quickly take a check at the market with the opening bell now ringing, and it has been a positive start but a very muted start, Santo. The Sensex and the Nifty just higher by about 0.2%, but the advances and declines are quite good.
Yes, 1200 stocks up and 400 down at this point in time, but these numbers have changed as the day progressed. We have seen the trend earlier also, where mid caps and small caps start on a steady note but then give up most of the gains by the end of the day. Nifty Bank is up by about 0.2%, Nifty Mid Cap up 0.3%, Mahindra & Mahindra among the early gainers up about 5%. NMDC is up by about 0.3%.
And
Bajaj
Santo-
Auto
Yeah.
by 0.5%.
Santo Nifty small cap also is doing quite well. The Nifty small cap 100 index higher by about 0.2%. But surprisingly, the India VIX has jumped about 3%. If I'm not wrong, I think if the graph will come up on the screen, we'll probably get a better idea. But clearly, it looks like the volatility index has seen a major spike today. Sectorally speaking, of course, banks are doing well. Auto companies are also holding up. The Nifty Metals pack is also has quite a good start. Actually, at this point of time, higher by about 0.2%. With the Nifty Realty Index struggling a little bit, down about 0.3% at this point of time.
Well, and moving on to the stocks on a watch list this morning, Aarti Industries is the first one. Now, CJ, this stock has been an underperformer in the chemical space for this current calendar year. It's down by close to about 35% from its peak. Now, it's a mixed bag for Aarti Industries at this point in time. One of the positive is that now it's a pure play chemical industries after the demerger of its pharma business, and there have been some problems in the recent past, higher freight costs, the logistics issues, and also costly raw materials. Besides that, there's also been a shortage of raw materials, which the company now has addressed to some extent with
nitric acid
nitric,
was one of the
20-year
raw materials
pact it has signed with Deepak Fertilizers, so that to some extent has been addressed. But the other problems still persist, and it's grappling with a double whammy of sorts of both lower realizations as well as demand weakness. Now, if you look at the fall in EBITDA margins during the quarter just gone by, that was pretty steep year on year, although quarter on quarter it was not all that steep. Now, there's slight softness in demand from both the textile as well as FMCG segments, which are its two key markets. But more than that, for Aarti Industries, the bigger problem at this point in time is that 50% of its sales largely come from exports, and given the threat of a recession in some of the advanced economies at this point, Aarti Industries does look a little vulnerable. Though again, to balance that, its capex programs are quite ambitious at this point in time, and it will have close to about 40 new chemical products by FY24, according to a report by Moneycontrol Pro. But the bigger risk to me, CJ, at this point is that a recession in US, Europe, and slower than expected growth in China. These are the bigger problems for Aarti Industries at this point in time.
I think, Santo, if you look at the decline in the stock price overall in 2022, clearly I think a lot of those fears have already been starting, market has already started to factor that in. Also, if as expectations are at this point of time, the recession in the US ends up being a shallow one, that is probably a 2 to 3 quarter long recession instead of a deep one that probably we saw during the COVID pandemic or even during the global financial crisis, then I think this could be seen as a largely just a near term blip on a longer term story, which is still very much intact. The new capacity that the company is bringing online in Dahej as well as Jhagadia, I think those are expected to drive earnings on the specialty chemical side, which generally tends to be high margin. So once those two units come online, I would expect that the margin performance should also improve. Also, as far as the nitric acid deal with Deepak Fertilizer is also going to be a game changer. At least they will be able to now secure supply, and that should clearly benefit as far as costs are concerned, probably in FY24. And overall also, one of the biggest reasons why Aarti Industries had seen so much demand over the past 3 to 4 years, 2 years at least, is largely driven by the China Plus One theme, Santo. And I think this is one of the stocks within the specialty chemical space which clearly is a beneficiary of that theme. So I would not be surprised if in the near term the stock is underperforming, but in the long, some investors might start looking at the stock from a longer term perspective. Well, moving on, the stock on my radar today would be Timken India. Now, this is an MNC which is a player in the auto ancillary space, and it seems like the stock is on fire these days. The stock is emerging as one of the top, performers in the auto ancillary space for 2022. And one of the reasons why we've seen a very rapid rally in the stock recently is the new aggression that the management is indicating. Now, of course, MNCs tend to hold, that blue-eyed boy sort of status, within the Indian market. And when you have an MNC whose management is also aggressive in terms of its growth plans, clearly that is like Sone pe Suhaga for Indian investors, and you can see that in the stock price reaction ever since they have announced a new capex plan. They are basically looking at an SRB and a CRB plant that they are looking to set up in Gujarat, and it is expected to re-rate the company's earnings because there is high demand at this point of time for SRB and CRB products within the auto sector. And overall also, despite the rally that we have seen, the stock's valuation as so far, Santo, do not seem to be, very, very expensive. It's reasonable. I think there is still scope for decent amount of re-rating to happen on this counter.
Well, the stock appears to be enjoying what is typically an MNC premium, because I see that at 66 times trailing earnings, it's not exactly cheap, but the numbers have been pretty good. FY22 in particular was a very good year for the company. The top line grew by about 50%, and so far in the first half, the numbers have been pretty decent. On the whole, hard to pick holes in this company other than valuations, but then if the growth is good, typically market also tends to assign a higher valuation. My point here is that CJ, it looks like from the price action and the volumes, it looks like suddenly the stock has taken a handful of big traders or operators, if I call them, have taken a shine to the stock. That explains a sudden surge in volumes out of nowhere. The stock jumping from over 2,700 to 3,500 odd in a matter of just about 2 weeks. That's quite a steep jump and huge volumes. But again, if you look, delivery volumes are not very high in the stock at this point. Volumes have risen very sharply. So it's a mix of fundamental and, I would say, a punt at this
speculation and fundamentals moving together hand in hand, it seems, in our market these days. That's the Santo, your last stock of the day that will be on your radar.
Safari industry, again a play on the recovery in travel and leisure. Now the company has been doing quite a few things. One, it has changed its sourcing arrangements, reduced dependence on China to a large extent, which is and is sourcing now a lot more from both India as well as Bangladesh, which has helped improve its margins significantly. And also, if you see, because of rising income, also generally there is a clear shift towards branded products. That is one of the triggers for Safari. Besides that, the company's range of products is it's both innovative, at the same time it is also it's competitively priced. This is the second advantage that the company is enjoying. Now, one thing which is slightly I would also like to flag here is that it's a very, very illiquid stock. So probably that also could have to do with the big rise. But then let's look at the fundamental side of the story, which is at this point in time appears to be quite strong. During the pandemic lockdown, what happened was that because of supply chain issues, the unorganized side of the market, they've taken quite a bit of a beating.
Market share,
and there's market share gains, there's capacity expansion. Earnings have been growing at quite a fast clip, and if you see for the first half of this year itself, Safari has done almost what it did for the whole of last year. So big jump in top line over the last couple of years. So this looks like a re-rating story, though I would also, this is one stock which also I would say that doesn't exactly fit in my criteria of stock because of the liquidity issue.
Well, getting out of your comfort zone, Santo, clearly I can see that. But, Santo, for all that rosy, fundamental picture, if you look at the stock's technicals recently, it's not really indicating that there is any sort of exuberance at this point of time on the stock. Clearly, if you look at some of the momentum indicators as well, there at this point of time, it seems almost that the stock is down and out. The RSI is below 50, the money flow index is below 40, clearly indicating that there is decent amount of selling pressure on the stock, although recently overall the performance may have been good. Yesterday also the stock fell below its 50-day moving average, which is never really a good indicator because that tends to indicate that probably there is some near-term pressure coming on the stock. Maybe people who have made a good chunk of profit, Santo, they're looking to realize. And I think while demand so far has been great, and of course there is that story of the shift of market share from unorganized to organized players, but I think in FY24 you could expect growth to mellow down a little bit, largely because of the fact that pent-up demand that has really aided this industry in the first half of FY23, I think that will fade away in FY24. So I would not be too surprised if the growth rate number, of course, also when you are at a higher base, it becomes that much difficult to sustain that same pace of growth rate. So I would expect growth to mellow down, but it will be very interesting to see if the stock can see any sort of revival in interest, given the fact that technical charts at this point of time are not indicating as such. Well, Santo, some thoughts coming in from our viewers, and Maddie Vibes wants us to discuss the current situation in Zomato, Santo. I mean, there have been a lot of high-profile exits from the company. The company's co-founder, who actually helmed the food delivery business, which is of course the bread and butter for Zomato at this point of time, he also recently quit. It seems like Dipinder Goyal, who is the CEO and co-founder, he'll be taking over that business. So at least that should assuage some bit of concerns on that business. But overall, a lot is happening. in this new
Definitely,
tech
but
company?
the prices again are not going anywhere. There was a lot of interest when the stock had collapsed to about 40 rupees when the pre-IPO when the lock-in period for pre-IPO investors had ended. Since then, there was a bounce back. Yes, and as CJ here will consistently argue, there's a clear improvement in the operating performance. The losses are narrowing down. This company was anyway not supposed to make a lot of money. The fact that losses are narrowing down at this point in time seems to be one of the positive, though I remain skeptical of the stock till it manages to show some good numbers, CJ.
I think, Santo, you are skeptical, but clearly the street is not. As far as the analyst community is concerned, they remain quite steadfast in their belief that this is a stock that is headed towards at least a triple digit over the next 12 months. There is a lot to like, especially in the recent earnings performance from the company. You have seen the food delivery business already looking towards breaking even. There's a possibility that by the end of FY23 or by early FY24, the company will break even itself on at a consolidated level. So that is clearly a very, very good sign. Also, the change in tone of the management has also taken a lot of investors by surprise. The management now seems very acutely focused as far as the profitability is concerned and bringing profitable growth to the company is concerned, and that's one of the reasons why I think they are also looking at trimming some of the fat in the company in terms of lowering its workforce. They're about 4% at this juncture. So clearly a lot of good things are also happening for Zomato, but it seems a lot of it is right now in the price. The market is probably waiting for much more execution as far as on the profitability is concerned to further re-rate the stock and head towards that triple digit number that it used to once enjoy back in 2021, Santo.
And well, unless there are more questions, let's wrap up this edition of Markets with Santo and CJ. Thanks for watching and also sending in your questions. We look forward to more of those.
And guys, keep following us on the social media links that you can see at the bottom of your screen. And for the rest of your financial news, stay tuned to moneycontrol.com and download the Moneycontrol app. We'll catch you again live at 3 p.m. Till then, have a great trading day.